At this crucial stage, new energy vehicles have arrived at a tipping point where 90% of the manufacturers may face insolvency. A price reduction of $100,000 for Mercedes-Benz, BMW, and Audi is no longer astonishing. Even the automotive titan Toyota offers a buy one get one free deal. The aftermath of the price war is plummeting stocks for automobile companies, including BYD and NIO, so people must wonder about the underlying cause of this situation. Traditional car companies venturing into new energy vehicle manufacturing is expected. However, Foxconn entering car production, real estate company Evergrande joining the race, and the participation of other major players led to the emergence of 100 Chinese new energy vehicle companies in the past decade. Regrettably, only BYD has turned a profit among these enterprises, with a modest 3% net profit. As 2023 unfolds, Tesla has thrice reduced its prices, and traditional luxury car companies have followed suit, with significant price reductions, leading to a drastic decrease in Chinese new energy vehicle brand prices. Incomplete statistics reveal that 30 to 40 new energy brands vanished in the first quarter due to the fierce competition, with the majority facing financial issues. Industry experts predict that very few Chinese automotive makers will ultimately survive. In March, Shanghai-based Wellmister WM Motor experienced a factory shutdown, the dissolution of its headquarters, employee layoffs, store closures, and even the brand's unfortunate association with the label of a deadbeat. According to reports, WM Motor's last round of financing occurred in March 2021, and after several financing rounds, the company raised a total of 47 billion yuan. From 2019 to 2021, vehicles with a production cost of 340,000 yuan could only sell for 120,000 yuan in the market, resulting in 78,900 units sold and a cumulative loss of 17.5 billion yuan. WM Motor suffered a 220,000 yuan loss for every car sold. Similarly, Shanghai-based Skywell Auto reportedly halted production on April 1st due to equity freezing. An internal notice attributed the suspension to financial predicaments and production and sales challenges, urging employees with new job opportunities to voluntarily resign. In March, Evergrande Auto, having finally commenced mass production, faced potential suspension risks due to its inability to secure 29 billion yuan in new financing. According to data from mass production and delivery in October last year to March this year, Evergrande sold a mere 900 cars. Such sales figures hardly win investors' trust in Evergrande's auto or raise their willingness to invest 29 billion yuan. In the face of this monumental shift, other surviving car companies are grappling with losses, with even renowned brands like NIO, XPeng, and Li Auto teetering on the brink of collapse. According to public records, NIO, a leading player among the new forces, experienced a net loss of 14.5 billion yuan in 2022. Each vehicle sale incurred a loss of nearly 120,000 yuan, representing an increase of over 70,000 yuan compared to the previous year. In the past 5 years, NIO has accumulated a staggering loss of 44.68 billion yuan. In a single week in mid-April, nationwide sales amounted to a mere 700 vehicles. More worrisome is the fact that by the end of last year, NIO's available funds could no longer repay the debts owed to the suppliers and banks. Overcrowded product lines and excessive costs for research and development, sales, and charging stations contribute to this predicament. If NIO cannot control these expenses this year, the projected loss for 2023 could hover around 14 billion yuan. In the capital markets where NIO primarily seeks funding, several prominent banks express pessimism towards the company. JP Morgan predicts a year-on-year growth rate of 50 to 60% for NIO's 2023 delivery volume, while Bank of America Securities has downgraded its sales forecast for the company for the next 2 years and anticipates increasing net losses. If NIO continues to lose approximately 14 billion yuan annually in 2023 and 2024 and cannot secure significant financing, its available funds may dwindle to around 17.5 billion yuan by the end of 2024. From a financial standpoint, this would suffice to sustain only about 1 year of net losses. XPeng Motors, the first quarter data reveals a 40% year-on-year decline in both sales and revenue, with a loss of 2.3 billion yuan, an increase of over 80% compared to the previous year. In 2021, XPeng Motors reported a net loss of 9.1 billion yuan, with each vehicle sale incurring a loss of 70,000 yuan. Statistics indicate that XPeng Motors' net profit margin has remained negative over the past 5 years, accumulating in a 5-year loss of 21.82 billion yuan. Guosen Securities, a Chinese state-owned financial services company, projects losses of 5.6 billion and 3.1 billion yuan for XPeng Motors and NIO respectively over the next 2 years. Currently, XPeng holds 11.4 billion yuan in cash and can only go on a few more years without profit. In 2022, Li Auto suffered a loss exceeding 2 billion yuan, with each vehicle sale incurring a loss of approximately 27,000 yuan. Despite achieving a net profit of 270 million yuan in the fourth quarter, the company has still accumulated a loss of 6.75 billion yuan over the past 5 years. Presently, Li Auto holds 37.5 billion yuan in cash. Without generating profit, the company can only endure for about 4 more years. In the second echelon of emerging forces, a succession of losses is apparent. Leap Motor experienced a net loss of 5.1 billion yuan in 2022, accumulating a net loss of nearly 10 billion over the last 4 years. Seres, regarded as a dark horse in 2022, is projected to suffer an annual loss of 3.9 billion yuan, amassing a loss of over 7 billion yuan in the previous 3 years. Nerja Automobile, parent company Hozon Auto, had a combined loss of 4.2 billion yuan in 2022 and 2021. GAC Aeon's losses reached 3.7 billion yuan from 2019 to May 31, 2021, with each year's losses surpassing the last. Geely's ambitious Zeekr venture also experienced a loss exceeding 3 billion yuan in 2021 and 2022. It is clear that these new forces that are already burdened with losses have limited capacity for future price reductions. As Tesla enjoys earnings of $10,458 per car sold and capital markets focus on profitability and operational efficiency, and faced with the prospect of Tesla further reducing prices and traditional automakers accelerating the rollout of new energy products, wealthy Chinese investors' continued support of this industry seems increasingly unlikely. Industry experts suggest that if Tesla persists in lowering prices, only a handful of China's 100 or so new energy vehicle brands will survive. BYD is the sole domestic new energy vehicle brand to achieve profitability, albeit with a low profit margin. Its gross margin hovers around 14%, which is lower than Tesla's net margin of 15%. BYD's net margin is even more disheartening, at less than 3%, while Tesla's net margin in 2022 stood at 15%, with a gross margin reaching 30%. Despite 3 price cuts this year, Tesla announced a 11.4% net profit margin on April 20th, 2023, for its first quarter earnings. This marks the 15th consecutive quarter of profitability, with a total quarter 1 revenue reaching 23,329 billion, a year-on-year increase of 24%. According to China's new energy vehicle insurance data for March, Tesla's Model Y and Model 3 dominated the respective markets in terms of pure electric vehicle sales. Model Y emerged as the best-selling SUV model in a single month, while Model 3 maintained its position as China's top-selling pure electric sedan. BYD could not offer a single model that rivaled these 2 Tesla models, as evidenced by the numbers in the accompanying chart. At present, Tesla and BYD's primary customer bases do not overlap. However, should Tesla continue to delve into the 100,000 yuan price range while maintaining its quality, it may very well pose a threat to BYD's market share. Interestingly, recent news indicates that Tesla plans to launch a more affordable Model Q, entering the new energy vehicle market for vehicles priced under 200,000 yuan. This development suggests that BYD's days of prosperity may be numbered. It is worth recalling that in March, BYD's unsold older models were reportedly stored on the second floor and above of unfinished buildings, with at least 100 units in inventory. With each vehicle priced at over 100,000 yuan, tens of millions of yuan are tied up in these unsold cars. The fact that they were hoisted onto the second floor of unfinished buildings indicates that neither BYD nor its dealers expect to sell these vehicles for several months. Otherwise, they would have been placed on the first floor, making them more accessible for potential buyers. This situation of unsold BYD electric vehicles has not escaped the notice of business magnate Warren Buffett, who has reduced his stake in BYD from 20% to 10% through 10 consecutive sell-offs since August last year. Not only Buffett, but also China's affluent middle class who might prefer to drive a Toyota Camry rather than BYD vehicles. In early April, Huawei's abrupt exit from the new energy vehicle industry sounded a death knell for China's new energy vehicle sector. The close relationship between Huawei CEO Ren Zhengfei and China's top leadership may suggest that the decision to cut Huawei's automotive endeavors was influenced by the Chinese Communist Party's highest ranks, who would prefer not to see Huawei burn cash in the electric vehicle industry. Tesla has demonstrated excellent cost control, as have renowned automakers Toyota, Honda, and Volkswagen. Once these companies complete their transition, the future of China's new energy vehicle industry will be dominated by these major manufacturers. In order to compete, BYD must continue to reduce prices, which will result in negative profits. Other Chinese automakers with even poorer cash flow control will face a bloodbath in this competitive battlefield.